All right, people are still joining in. However, we're going to start. Hello and welcome to the IME webinar about AI trades. I am Shagun, and today we're talking about something that is top of everyone's mind, AI. Many of our investors at IME Capital have been asking us how they can participate in this very strong global AI trade. The underperformance of the Indian markets over the last year and a half, the rupee depreciation, continued FII flows, and the sharp outperformance of AI driven markets such as US, Taiwan, and Korea. All these factors have led to a very high level of interest amongst Indian investors who feel they might be missing out. Keeping this in mind, today we have Ashi Anand, founder and CEO of IME Capital, talking to us. Ashi has been a fund manager since the start of his career and has seen how the finance industry has adapted itself to changes over the years. Ashi has been known to spot trends early on, enabling him to outperform the markets, as is evident with the success of his digital disruption PMS. Today's webinar looks at AI trade from an investment perspective, identifying the many different manners in which historically high levels of AI capex are throwing up interesting investment opportunities across the world. Indian investors currently have limited AI related investment opportunities within the country. And so the aim of this webinar is to help them figure out how best they can participate in this transformational investment theme. We do have a time for questions, but I would request you to please type them in the chat box. And once the presentation is over, I will address those questions. Without any further delay, Ashi, over to you.
Great. Thanks so much. Thank you, Shagun. Thanks for the introduction, and thank you so much for all the participants for joining today's webinar. It is a very, very interesting topic. This is a once in a generational kind of capex cycle that we are really seeing, and there are a lot of very interesting investment opportunities that are being thrown up across the entire global AI value chain. Just to kind of give you some context in terms of what we'll be discussing in today's presentation. There are three broad sections. We'll start with a general background and an introduction to the theme, which really covers the kind of introduction to the kind of technology waves that we've seen over the years and understanding how AI is moving from concept to a very large capex cycle. The second section really breaks down this $1 trillion plus opportunity that we're seeing in terms of AI capex over the next couple of years, trying to identify the key beneficiaries. We identify 5 key layers as well as specific countries that we believe are going to benefit. And this kind of naturally leads to the final and arguably one of the more interesting parts, which is how exactly can you as an investor, with a very large number of participants on today's call would be sitting out of India. How can Indian investors really participate in this very interesting theme, given that most AI companies are actually based overseas? We will kind of very specifically address this point on are we too late? We'll look at kind of specific risk around AI investing, and we'll help kind of try to help address how exactly you as an Indian investor can actually participate in this very interesting opportunity. With the kind of agenda set, let's just move on to the core. And we'll start off with kind of just understanding technology kind of waves and technology cycles. What you have seen so far is three broad kind of eras in terms of innovation cycles. The first was actually um, the agricultural revolution, which would have started in kind of 10,000 BC. This is where agriculture food productivity shifted from subsistence survival to economic surpluses, resulting in kind of large food abundances. The Industrial Revolution from the 1800s led to mass production, which helped reduce goods and expanding global trade, leading to an abundance of goods. And then we had the whole information age in the late 20th centuries, where kind of machines complemented manual labor, dramatically increasing the output per hour. This led to an abundance in information and also a big reduction in the overall cost of distribution of a large number of digital products. Now, these have been the three major eras of innovation so far. What we are now seeing um, what we are now seeing is a shift towards what we call the intelligence age. This is actually something very, very nascent. It's only started the last couple of years. And AI is basically driving this structural shift away from the information age to the intelligence age. And I think a key element here is while the internet age really led to a dramatic cost in the marginal cost of distribution, allowing kind of digital goods and information to be circulated very rapidly. The intelligence age is actually is captured via a big reduction in the marginal cost of cognition. Basically, intelligence is becoming abundant. And this basically is likely to lead to a big improvement in kind of human productivity. And you are likely to, as we going through the years, see structural productivity gains through large parts of the entire economy. Now, before we kind of get into really understanding what AI is and what this entire AI age is, it's very important to understand a key element about what has been helping the sharp and rapid improvements in kind of technology and what is really leading to the whole AI wave. There is something in semiconductors called the Moore's law, and the Moore's law basically is something which came out a long time ago, where Moore's basically indicated that the number of transistors that you can fit in an integrated circuit can actually double every 2 years. And this has been something which has actually held up over the last 4 to 5 decades. Every 2 years, you have roughly seen a doubling in kind of transistor capacity. And this basically leads to not only a significant improvement in computing power, but also a dramatic cost reduction in terms of computing. Now, this kind of doubling of semiconductor kind of capacity every 2 years is what has led to these dramatic tech waves that we've seen over the past few decades, starting from the mainframe era in the 1970s to PCs in the 1980s, the internet age in 1990s, mobiles in 2000s, cloud computing in 2010, and now the kind of AI era in kind of 2020. Uh, what is really interesting about the AI era is you're seeing AI adoption rising at a pace that has never been seen before in history. ChatGPT crossed 100 million users in 2 months. This level of pace of adoption was unimaginable earlier. Now, one of the big reasons that is actually driving this kind of pace of adoption is the fact that AI works on top of an existing device ecosystem. AI works on your existing laptops, it works on your existing kind of smartphones, and therefore users don't really need to capture new hardware or buy new hardware in order to use AI. And this is what is driving a very, very rapid increase in adoption of AI services at a level that has never been seen before in history. Now, let us understand something very important, and that is basically what is happening in terms of AI and its transition from a concept to the capex cycle, right? And this is really the core thesis. Now, in order to understand this, it's important to understand something called the scaling laws in AI. Effectively, what you have seen is each new generation of AI has actually been trained on much more expensive and much larger hardware, requiring much more energy and a significantly larger amount of data points. You can just look at from 2000 when you were kind of training AI on data points of tens of thousands of data points. You're now training AI on trillions of data points. What used to cost 100,000 in the early 2020s is now costing over 100 million to just the hardware and the energy cost to train some of these major AI systems. Essentially, in order to get superior AI models and superior intelligence, you need higher computing power and larger data sets that these AI models are being trained on. This is a very critical insight because essentially, the race for a superior model is actually intrinsically linked to the race for access to higher computing power. And as we kind of going through, you'll understand why this is so important in terms of throwing up some very interesting investment opportunities across the whole computing power ecosystem. Now, it's important to just understand before we get into kind of mapping the value chain, understanding this AI data center. AI data centers are extremely complex data centers. They are much more complex than data centers of the past. They use cutting edge semiconductor, memory, and server equipment. These tend to be extremely expensive. A single gigawatt of a AI data center can cost anywhere between 15 to 25 billion dollars. Now, every data center that is being set up leads to incremental demand across the entire AI value chain. You're kind of leading to kind of demand across foundries, memory, networking equipment, power cooling, and substantially more. Now, we have kind of multiple times spoken about this $1 trillion capex opportunity. And this is just what it is, right? Now, AI is effectively driving one of the largest capex investment cycles in modern times. You asked, it's this unleashing opportunities across a global supply chain. And very importantly, the biggest bottlenecks in AI is increasingly computing power and energy, not software. This chart shows you the tremendous scale up that you're seeing in the capex of the AI hyperscalers. A $240 billion capex in 24. As you get into 26 and 27, you're talking about over $500 billion per year. Over 2026 and 2027 alone, just the AI hyperscalers are looking at spending over $1 trillion. This is an unprecedented level of kind of capex in a single industry. And it's really a once in a generational kind of a capex cycle that we are really seeing. Now, one very important element is that is this kind of scale of capex likely to continue? And I think the way we look at this is if you understand AI and you understand the big tech companies, the loss on the AI race is virtually becoming an existential threat for AI companies, for the largest tech companies. Most companies and all their management commentaries are all talking about extremely strong demand. And really, it is kind of capacity constraints that is preventing the launch of a lot of incremental services. And a lot of this capex is actually being set up by kind of these large hyperscalers that have very strong cash flows from other lines of business. And this is really kind of helping it. There's no shortage of financing per se. And given the fact that we are really talking about an existential threat, the loser of the AI race may not exist a decade ago. Most of the largest tech companies really see this as you have no option but to invest. Now that we've kind of understood, right, really what this opportunity is, let us now kind of sit and break down this opportunity. But sorry, just before we get into that, if you're just looking at kind of the market performance of a number of kind of benchmark indices, other kind of portfolios, etc., exposed to the scene, you have seen significant outperformance over the last 1 to 3 years. Now, this is something that we intrinsically believe is going to continue on the back of these very large spends. In this next section, we will actually sit and deconstruct this $1 trillion opportunity that we are looking at to understand what are the key kind of players that are beneficiaries of this particular theme. We identify 5 key interdependent layers. We'll go through each one of these and kind of take you through what the opportunity is, what are the kind of companies that are likely to benefit, and it actually helps you understand where really the largest investment opportunities are arising from. Um, Now, AI effectively spans a wide and an interconnected value chain, ranging from core hardware to the physical infrastructure to software programs. You start from kind of model makers, it goes towards cloud providers, the entire semiconductor and computing value chain, to the various kind of supporting physical infra, energy, and materials required to support this kind of business growth. Right, so these are effectively the core layers. We'll go through them one by one. Starting with kind of layer one, the AI model developers and the platforms. Now, these are the people who are actually building the AIs that we use. It could be Gemini, it could be Claude, it could be Grok, it could be ChatGPT. The major model providers, now the amongst the key leaders, Google is currently the only major listed player. OpenAI, Anthropic, Grok continue to be unlisted. There are unlisted deals that open up in these companies every now and then for people with the right amount of capital. But there are very often these deals that do also open up. But it's important to understand that the other major cloud platform providers that we mentioned here that are all listed, Microsoft, Meta, and Amazon. Firstly, not only are they direct beneficiaries because they are actually kind of creating and building the kind of data centers that kind of the model providers are going to be leasing. But all of them are actually also working on their own models. So Meta kind of has Llama, Amazon has Nova, and Microsoft, though, very clearly has a very strong tie-up with OpenAI. Given the substantial resources that they have, some of these models may also emerge to be future winners. Now, when you are looking at kind of AI model developers, it's important to understand that we're still very, very early in this technology cycle. Leadership is constantly changing. Different models differ in terms of specific skills, that one model may be better in certain skills as compared to the other. And at this point in time, I think the long term winners are still quite unclear. And you can't really predict it at this point in time. And this is kind of one of the key uncertainties around investing in the space is you don't really know who the long-term winner is likely to be. Also, monetization of this very large hundreds of billions of dollars of capex is still not fully kind of understood. That said, let's understand layer two, the entire computing hardware layer. Now, this is effectively, you can break this up into three core parts. One is the compute training or the semiconductor design firms, right? These are your Googles, NVIDIAs, AMDs, etc. You then have a very large space of the key components. Now, this includes your semiconductor, your memory, various other networking equipment. And lastly, you actually have people who are creating the equipment used by the manufacturers of kind of hardware. We will look at each of these independently. But before we kind of do that, one important element to understand is that some of these stocks have already moved quite significantly. But as we will show, a lot of this growth or stock movement has actually driven by earnings growth as compared to any abnormal valuation re-rating. These are companies at the forefront of the AI wave. And if you're looking at kind of forward Ps, it's really not something which is extremely expensive or abnormal. Lastly, this is also the core infrastructure layer of the AI trade. Just to explain what we mean by this, these are also very often called a pick and shovel play. Now, a very good example, and this is something used quite often in kind of investments, is if you go back to the gold rush. Someone who was going out and prospecting for gold may or may not have found gold and may or may not have made it rich. But anyone who was manufacturing shovels, anyone who was selling shovels, that industry really boomed. So when you are looking at kind of investing in AI, while investing in cloud platforms and the actual model makers come with a decent level of uncertainty around who the eventual winner is likely to be. When you are kind of investing in these pick and shovel plays, no matter who the eventual winner is, these you will need more semiconductors, you will need more memory. And that is why this entire layer of computing hardware becomes quite interesting. Let's look at each of these segments now, one at a time. The first is really the entire semiconductor design kind of firms. Now, this is a critical layer, and semiconductor design firms are basically the IP owners. They own the intellectual property of computing power. These companies design chips, they design the hardware and software that goes into a semiconductor. They optimize the performance and they own the intellectual property. They, however, do not manufacture. Now, within the kind of semiconductor kind of design space, very clear winners and losers are likely to emerge. NVIDIA is currently dominant with almost a kind of 90% global market share. But Google is rapidly catching up, especially in kind of inference models. The people who win here are likely to have huge margins and value creation. This is kind of it is likely to be a space where there is going to be quite a big difference in terms of the value creation between the winners and the losers. Now, just to kind of understand or appreciate the opportunity that we are looking at, just look at the way NVIDIA's revenues have scaled up. In 2023, when ChatGPT was basically launched, NVIDIA was running at a $7 billion quarterly run rate. In just under 2 years, that revenue run rate has scaled up to $55 billion. When you see very strong price movements, please also of stock price movements, please appreciate the sheer scaling up of the value or the size of the businesses that you are looking at. This is just one kind of example of the sheer scale up that you are seeing in the kind of overall size of companies and the growth potential of companies in the AI value chain. Now, while semiconductor design firms design kind of semiconductors, they actually get their actual manufacturing done by what are called semiconductor fabs or semiconductor fabricators. Now, this is an extremely complex and highly capital intensive space. A single advanced fabrication unit can cost anywhere between 15 to 25 billion dollars. And what's interesting is that a single company, TSMC, is dominant, is a globally dominant in the space. It has a 70% global market share. And when you get to really advanced kind of AI driven chips, it has an even higher market share. Now, they have such strong demand that they are really, really struggling to kind of meet up with the demand which is coming from various semiconductor design firms. And this is actually leading to a very large spillover demand to other players such as Samsung, UMC, SMIC, and others. Similar to kind of Nvidia, you can see a very strong scale up in revenues for TSMC, as well as a big increase in capex. They used to spend about $10 billion per year in 2018. This got scaled up to about 20, 30 billion over 2022 to 24. And they've recently announced scaling up the capex to $55 billion. Um, so you are again quite clearly seeing very clear increases in actual business size. It's not just concept, it's not just a story. This is real world kind of demand leading to real world scale up of businesses. This leads us to a third segment, which is the people, right? Semiconductor equipment companies. These are companies that sell the machines that actually make the chips. It's a very, very interesting kind of a layer and extremely concentrated. Amongst this, ASML is a Netherlands based company which is often considered to be the most critical bottleneck in the entire AI value chain. This company is a monopoly player, the only company in the world that can supply EUV or what is called extreme ultraviolet lithography machines that are required that go into the manufacture of advanced semiconductors. Applied materials, Lam Research are other kind of key players, but ASML is kind of very often considered because every single company in the world ultimately depends on their equipment to manufacture these semiconductors. You also have another range of other kind of interesting players in the entire in the computing hardware space. A memory is a very important layer. Now, basically, while are used to process and intelligence requires to be able to process or think, they also need to remember. And high bandwidth memory is basically critical for advanced AI memory. Out here, SK Hynix is the clear global leader when it comes to HBM memory. Micron is gaining quite rapid share, and Samsung was also quite dominant in certain components of kind of memory. You also have fairly interesting opportunities coming out across networking equipment, server equipment, and other forms of equipment that go into advanced data centers. And you have players like Broadcom, Marvell, Supermicro, Arista, and Dell all kind of competing in this particular space. So that really explains the entire computing hardware layer. With that, let's understand the physical infrastructure layer. Now, effectively, all computing hardware has to be placed in particular buildings. These also have tremendous energy requirements, and they're also very complex cooling and other systems that are required to run these data centers. This leads to huge opportunities for companies that are actually building out this infrastructure. As for example, there's this company called Vertiv. After NVIDIA, Vertiv has actually been the biggest value creator amongst all AI data stocks over the past 5 years. It really shows how AI is just not about computing, is not just about models. You're really throwing up opportunities across a large amounts of space, including the building of physical infra. Now, when we are talking about physical infrastructure, the very clear and strong opportunities being thrown up across electricity, across cooling equipment, as well as physical real estate. Just kind of concentrating on looking at electricity, and this is something which is very often spoken of as a key barrier or bottleneck in AI. If you're looking at kind of the use of electricity, and just to put this in context, already as of today, global data centers already have electricity demand that equals to that of advanced sovereign nations. Data centers are already using 100% of France's electricity demand, over 150% of UK's electricity demand. And as per projections in 2030, data centers alone are likely to account for electricity demand that accounts for 50% of India's current electricity consumption, or 25% of US's current electricity demand. This is a sheer scale up of kind of electricity demand that you are looking at, and which is why you would kind of hear of a lot of talk around advanced fuel cells, around nuclear power coming back. You have distributed micronuclear reactors. A lot of kind of new age tech is coming out around electricity because of the sheer quantum of requirements of electricity to power these modern AI data centers. All of this infra build out will also require a very large quantity of materials. Now, this will throw up huge incremental demand across a large number of kind of commodities. Now, a few specific kind of materials in particular, rare earth materials. Now, the reason you would have heard of rare earth materials quite often is because these are critical for various components kind of used across kind of semiconductors, memory, cooling, etc. Uh, but apart from rare earth materials, you're also kind of likely to lead to sharp increase in demand for things like copper, for silver, other conductive materials, various specialty gases, etc. So there are going to be specific kind of material or commodity plays that see very sharp price movements because of the sheer explosion in demand that AI capex is likely to drive. Coming to a couple of the last kind of benefits of the final layers, you have the actual end users of kind of AI. Now, ultimately, there's the biggest value of AI is likely to accrue to businesses that can truly leverage AI into their business workflows. You're likely to see the emergence of certain moonshot innovations, pure, aggressive, disruptive innovations in areas like drug discovery, robotics, advanced computing, various other kind of areas. And there could be very, very interesting innovations that AI will actually help enable. You're also likely to see large disruptions in the existing businesses that do not innovate rapidly. So I think when you're looking at the kind of end users of AI, you're likely to see big winners and big losers. You can't necessarily predict all of them as of right now, but it is important to understand that the kind of business landscape 5 years, 10 years from now is likely to be significantly different from the kind of competitive and business dynamics as of today because of how different companies really use and leverage AI to improve their business processes. Uh, The final part in terms of just deconstructing the value chain is understanding which are the countries that are likely to be major beneficiaries. Now, the US is very clearly one of the biggest and one of the most obvious beneficiaries. It is the IP leader of AI globally, and it dominates AI models, the cloud platforms, and various kind of advanced semiconductor design firms. So while US is the clear IP leader, you also have kind of countries like Taiwan and South Korea in particular, which are very strong manufacturing hubs. Taiwan in semiconductors, South Korea in both semiconductors and kind of advanced memory. Something which is likely to, China is likely to potentially be a very, very strong dark horse. You have limited visibility of what's happening within China, but China has time and time again proven its ability to kind of make rapid advances in kind of technology. And you may just see China kind of emerge in terms of advanced AI models, advanced computing hardware, etc. Other country beneficiaries are also likely to be Japan and Netherlands, which control various strategic equipment and material choke points. So this is broadly, right? This was trying to just uncover, understand the various different components of AI demand and the different components of the value chain that are likely to be beneficiaries. This leads us to the third and final stage of today's presentation, which is trying to understand how you as an Indian investor can actually participate in this theme. But just before we get into that, just a small little reminder, any participants that have any questions, we will be taking questions, but at the end of the presentation, so please do kind of, any questions that you may have, please kind of feel free to kind of put them in the chat box. We will cover all questions that you have at the end of the presentation. That said, let us now look at understanding the actual investment options that exist for investors. But before we answer that, let's answer a very, very important question. Are we too late, right? Because we have seen kind of through the presentation, we've shown you various stock price graphs where clearly there has been significant movement so far. Now, let's look at this from a few different aspects. Point number one is ChatGPT, right? The most leading or cutting edge kind of, or the one which has made AI so prominent, is only in its third year and within 3 years has already penetrated 10% of the global penetration. But just to kind of understand how nascent 3 years is, look at internet penetration. It's been 25 years for the internet, and you are still seeing rapid growth in adoption. It's the 15th year for mobiles, and you're still seeing kind of rapid increases in penetration. Not only does penetration have significant room to grow, less than 10% of mobile users are currently using ChatGPT. But I think another very important element, apart from just are you using ChatGPT or not, is actual usage. Usage remains hugely below its potential. Most enterprise workflows remain untouched by AI. Industry specific AI applications are still extremely nascent, and most consumers and consumers are still only dabbling in kind of AI. As companies, individuals, and industries get more and more comfortable with kind of AI, you will see usage continuing to grow. So it's just not getting incremental users, but existing users also using AI significantly more. Effectively, we are saying we believe we're still very, very nascent in terms of this entire penetration that you are seeing. The second important element is if you're looking at actual stock price movements, apart from a few specific companies, some of the largest movements in terms of stock prices are only about a year old. Now, a 1 year kind of a move, a 3 year move for a once in a generational capex cycle, this is not very late in terms of kind of value creation. You know, it's obviously always best to kind of have gotten at the absolute bottom. But a year down the line, you're still quite early in what we believe is going to be a multi-year structural story. And another very, very important element is that the vast majority of the stock price movement has been driven by a significant scale up in overall business value. Just look at the sheer scale at which businesses have grown, and these are kind of global businesses that traditionally have grown at much slower rates. And if you're looking at the kind of huge tailwinds that we've spoken of in previous slides, we believe that there are many, many years to of growth to continue. Now, if earnings growth has kind of supported stock price movement, and if you have many years of very strong earnings growth to continue, we believe that you still have many years of stock price outperformance to kind of continue. And because kind of most stock price movements have been driven by scale up in businesses, across the board, valuations of many companies are still fairly reasonable, especially in the context of the quality of some of these companies and the sheer growth potential that you see. That said, one important disclaimer: anything tech tends to be extremely volatile. So please don't kind of expect kind of sustained month on month, quarter on quarter kind of improvements. You are likely to see large volatility in terms of value creation. But in terms of the larger value creation because of the AI trade, we believe we are still relatively in the nascent stages. Now, one very important element to understand is that AI investing is structurally very complex. It's not a single AI trade. There are multiple different ways to play it. And there are many things that lead it to being a lot more complex than traditional investing. There are multiple layers that are all kind of evolving together. There's extremely rapid technological shifts. A year and a half back, it was only NVIDIA. Google TPUs have suddenly emerged. OpenAI was the leader. You're suddenly seeing Gemini kind of catch up. Big technological shifts. Huge capital intensity that is likely, and big capex spends that could lead to kind of delayed returns. There are large geopolitical kind of risks. There's large supply chain risk. Sentiment can swing around quite significantly. There's uncertainty on monetization. Now, effectively, while we are aware and we know kind of various companies across the value chain, we strongly recommend against investors trying to invest directly in individual companies. The space is incredibly complex. You need active fund management to help kind of navigate kind of rapidly changing dynamics and position portfolios accordingly. Now, it's important to kind of understand that because a large part of the AI value chain, and a lot of you would have noticed that India really didn't stand out in any of the kind of companies that we were discussing. A very large part of the value chain is actually international. Now, when we are talking about the international value chain, and if you need to kind of participate via international assets, there are really three ways to kind of approach this. Firstly, you can kind of invest directly via a US broker. There are Indian feeder funds, and there's also kind of a Singapore-based advisory platform that we have. Now, one of the reasons we strongly recommend the Singapore-based advisory platform over either direct investing via US brokers or via feeder funds is there are specific problems with the other two routes. The first problem with direct investments through US brokers, right? And there are a lot of platforms, say, for example, in India, you can open an account via StockAl, via Interactive Brokers, and invest directly in US companies. Uh, there's something which is very important, which is when you're investing directly in a US based company or a US domiciled company, or if you're investing in a fund which is domiciled out of the US, you are exposing yourself to estate duty risk or inheritance taxes. Effectively, if you were to pass away, the US government would take away 40% of your assets above $60,000. Now, letting go of 40% of assets and inheritance taxes is just, according to us, is nothing worth taking that particular risk. And which is why we strongly recommend any investor against investing directly in a US domicile fund. If you're making very small investments of a few lakhs, it probably doesn't matter. But the moment you are investing any serious capital, 11, 30, 40, 50 lakhs, you are expecting that capital to grow. You could very soon cross that $60,000 threshold. Exposing yourself to inheritance taxes and 40% of your capital being wiped away in case of untimely death is something which clearly we believe is not worth it. You have various feeder funds in India. However, what happens is, I think the biggest problem here, there are two big problems. One, you really don't have that large a range of options to choose from, and some of the specialized AI funds don't really exist as feeder funds in India. And because a lot of these have kind of limits, a lot of these are very often not open for investments. Gift City is also available, but Gift City is also honestly just way too early, and you really don't have the same amount of investment options that are available. And which is why, we really prefer the Singapore platform or the Singapore route for investing internationally. Not only do you get a large amount of investment options that are available, but you also have, by being careful about choosing funds that are domiciled out of jurisdictions apart from that of the US, such as Ireland, Luxembourg, etc., you can actually invest in kind of US tech, invest in kind of the global AI trade without having to expose yourself to estate duty or inheritance taxes. Now, with that having been said, let us get down to the actual ways to invest. How do you as an investor actually invest in some of these? There is no single one AI trade. Effective participation really requires understanding the entire capex cycle, the various beneficiaries, and understanding what parts you want to participate in. You either can participate in the core growth exposure, which are the US tech funds, which are the model providers, semiconductor design firms, etc. This could be slightly higher risk. You may want to take the pick and shovel approach, saying, let me invest in the computing infra funds, the data center REITs, etc. Or you could look at specific geographies, resource exposures, and actual AI end user innovation funds. Now, we have actually sat and we've identified the specific funds that kind of exist and that we believe are kind of good options within this. And all of this is available on our platform called the IME RMS, right? So let me just kind of quickly dive into the IME RMS and just show you what are some of the funds that are the kind of major beneficiaries that we believe represent possibly the most interesting opportunities within the kind of overall AI trade. Just give me 1 minute, I'll just shift over to the actual RMS.
I see that there are some questions. We will come to these later, but if anybody else has any questions, please feel free to type them in right away. Thank you.
Thanks for that, Shagun. Yeah, so basically, what we have identified here are some of the key or major fund beneficiaries that we believe represent some of the more interesting funds available to invest in the entire AI value chain. But just before kind of we get into that, let me give you a very basic 1 minute pitch for our own services, right? And what the IME RMS really is. Now, the IME RMS is, or the IME Research Management Solution, is our wealth management product that we've designed to try to address what I believe to be one of the biggest problems in the wealth management industry, the very weak flow down of insights in the wealth management value chain. Effectively, as information flows down from fund managers to the central research team of wealth management firms to private bankers and then finally to end investors, a lot of critical and very important insights actually get lost. Now, we have designed the IME RMS and this is the first platform in India where we are giving our investors direct access to IME's central research team's insights and detailed fund rationales, covering a wide universe of mutual funds, PMSs, AIFs, global investment opportunities, and
Ashi,
kind of SIFs.
Ashi, I think you're on the wrong screen. Just sorry to interrupt, but
Yeah, sorry, Shagun, what screen am I on?
it says rmsimecapital.in. It's from the presentation. I think you wanted to switch to the
Yes.
RMS.
Thank you. Thank you. Thanks so much for that, Shagun. Hmm. Sorry, guys, give me just 1 minute.
I'll let you know when you've come to the right screen.
Yeah. Mm, yeah, can you see the RMS now?
Yes.
Okay, great. Perfect.
Just on the OTP, right? You're on the OTP screen.
Yes.
Okay, great.
Yes, so effectively, the RMS has been designed, as I mentioned, to give investors direct access, you right, to our central team's core database in terms of how we look at and how we evaluate funds. What we want at IME Capital is to try to collapse these artificial barriers that exist in the investments industry between kind of fund managers, central product teams, etc., and ensure that investment advice is driven directly from central research and not via sales incentivized private bankers. We are the only platform in the country where if you're looking at a particular fund, and if you click on that particular fund and if you've given it a particular rating, you sit and understand all aspects around how we have rated that particular fund, how it's performed, what is our rationale, what is it that we like or don't like about a particular fund, our view on the category, our view on the AMC, the team, etc., etc. Um, it's a very interesting platform. We really strongly encourage people to give this a try. But with that said, let's just go down to the core, which is what are the specific companies that we've identified within the kind of AI trade, right? And you kind of within funds, there's recommendations, and these are kind of the top fund ideas that we're currently seeing in the AI trade. Now, as I mentioned, there are different buckets. You first have what are kind of the US tech funds. So, some of the funds we've identified include BlackRock's World Technology Funds, the Fidelity Global Tech Fund, Invesco's NASDAQ QQQ, the largest tech fund in the industry. This, according to us, is one of the core holdings within the AI trade. You're really getting exposure to the AI model providers. You're getting access to the semiconductor design firms. You'll also get access to the fabs and all of that. This is kind of pretty much the core. A lot of investors who've been active, LRS investors who've been active over the past few years, are likely to already have exposures to this theme. Now, one important thing which is important to understand is that when you are investing here, and this is what we kind of have on our platform. If you invest, if you click on a fund, you see something for international funds here indicating estate duty exposure. So if you're investing in a BlackRock World Tech, you don't get kind of estate duty exposure because it's actually that's domiciled out of Luxembourg. But if you're investing in a NASDAQ QQQ, you are getting kind of a state duty exposure because it's domiciled out of the US. So the moment you are kind of looking at international investing, um, it is very important to understand the jurisdiction or the domicile of the fund because you invest in this fund, if you were to pass away, nothing happens. Your beneficiaries in your will get all the money. When you invest for NASDAQ QQQ, 40% gets taken away, above 60,000 will get taken away by the US government, right? So it is important to understand some of these nuances. This, however, is a space that arguably is better understood. Coming to kind of the computing infra play, right? And this is really what we had kind of spoken about the pick and shovel play. Don't go searching for gold, manufacture shovels, sell shovels. So we have kind of identified various AI infra or semiconductor uh, kind of funds. But it is important to understand that not all of these are the same. And let me just open these out to kind of just explain why. While most of these are structured as passive investing funds, they all kind of are targeting different indices. So your iShares AI Infra is replicating the stocks A Global AI Infra Index. You have kind of the iShares MSCI Global kind of targeting the MSCI ACWI IMI Semiconductor and Semiconductor Equipment Index, right? And if you go to each one of these, you'd find specific indices that they are tracking. Now, this actually leads to differences in exposures because some of these are tracking indices that are linked primarily to US companies. And because a lot of investors are likely to already have US tech in their portfolio, you probably want to stay away from a fund which is pure US exposure, right? So if you're looking at someone like an SBDR, S&P Semiconductor, it has a kind of 100% exposure to the S&P. But when you are looking at an iShares MSCI Global, you are kind of getting kind of global exposures, and you're getting exposure to some of these main companies that we've been speaking about, the ASMLs, the TSMCs, AMCs, NVIDIAs, etc. Out here, I think clearly, and we don't really have time to go in depth into each of these funds. But I think within the kind of funds we've looked at and in the context of what we're trying to play, we see iShares AI Infra and iShares MSCI Global Semiconductors as being two of the most interesting opportunities. You also have country kind of dedicated funds. Now, here, kind of Taiwan and South Korea dedicated funds are clearly kind of interesting. But I think another key element, another very interesting fund is your iShare Asia 50. While this is a diversified fund, it's not a tech focused fund. What is interesting is that if you're seeing its country exposure, you're really getting exposure to through the big three of Asia, of Asia tech: Taiwan, China, and South Korea. All of these countries are likely to kind of benefit quite significantly from kind of AI capex, and this fund is kind of giving you diversified exposure to each of these economies. Um, Now you get to some of the fancier funds, and one very important element, and I'll just try to show you some data out here. But while some of these funds may sound very interesting and very sexy, it's important you don't get too excited or too carried away. Now, if you just look at some of these returns, right? Some of these have just doubled over the past year. So if you look at some of the electricity funds, some of the commodity funds, etc. But it is important to understand that these can be hugely volatile funds, and it's these funds are probably only kind of appropriate for investors with very high levels of risk tolerance or volatility tolerance. Something like a VANIC rare earth fund, right? And rare earth is what everyone is talking about. While it is something which has been in the buzz for the last 2 or 3 years, before the big move you saw in 2025, you've actually seen a 30% drawdown in 22, a 19% drawdown in 23, a 35% drawdown in 24. You've also seen something similar in terms of some of the clean energy funds, right? So 21, 22, 23, 24, all being not just negative years, but substantial negative years, right? So while some of these cutting edge kind of plays around electricity and commodity and rare earth may sound very interesting, it is important that you really understand whether it fits within your overall risk profile. So guys, I think that's the core, that's the kind of end of today's kind of presentation. I think just one last thing to kind of mention. We do offer all investors, especially people who've joined this today's webinar, a free kind of 15-day trial of this platform that we are showing you. This platform is otherwise exclusively meant for our clients in the wealth management business. It gives you direct access to kind of insights at a level which once you actually go through the platform, you'd understand the kind of information and insights you get here is not available on any other platform. If you do or are interested in signing up, all you have to go is go to rms.imecapital.in. You put in your phone number, you'll get an OTP. Just put in the OTP. There are a few small questions. Just answer those, and you get access and you get a 15-day free trial. With that, thank you so much for listening. My apologies. We went on a bit longer than I was expecting, but it was a fairly extensive topic and there was a lot to cover. So thanks once again for patient listening. And with that, Shagun, over to you for any
Yes,
questions that may be
Sashi,
there.
you're not through with us yet, so we have some questions. Rahul wants to know what about the claims that all of this AI is just a boom in prices, and is it just one of those big myths? I think is that's the question.
So when we are saying boom in prices, right, I'm not very clear what he's indicating, but see the core of the AI boom, right, and the core call on, because there are a lot of people who are saying that AI is overhyped. There's too much money being spent. There's uncertainty on monetization. It's not that everyone is just a big bull. There are a large amount of naysayers in terms of AI itself. I think the core crux is that when you are sitting and spending 500 or 600 billion dollars setting up a data center, two key questions. Is that computing power going to be utilized? And secondly, are you going to be able to charge the end consumer for it? Now, while we will only know some of this a bit in hindsight, I think there are a number of very clear trends that are apparent here. Firstly, across the board, most AI kind of model companies keep indicating that they are capacity constrained. They're not launching the entire range of services that are possible because they lack capacity. Um, So as new capacity comes in, a lot of these incremental services can come in. We did kind of speak about the fact that we only the third year into kind of the launch of AI services to the end consumers. Enterprises are still not using AI. Consumers are still not fully using AI. The sheer quantum of kind of uh, requirements for kind of intelligence and to be able to interact with intelligence on a computer. I think it's quite easy to see multiple use cases emerge that would actually use this capacity. The other question is in terms of monetization. Can you charge the end consumer? Now, I think out here, if you just look at what AI can help you accomplish, you can chat with AI and you can get answers to complex legal questions, complex medical questions, complex coding questions. All of this at a fraction. I'm talking about probably 2 to 3 or 5% of the cost of trying to sit and ask that question to an existing professional. IT talent is amongst the most expensive talent in the world. AI can actually significantly boost their productivity. If I'm paying an IT employee, say, 1 crore a year, and I can boost his productivity by 2x or 3x or 4x. Um, Arguably, you should be willing to pay 3 crores a year for that. And the actual kind of spends on AI is significantly lower. So I think we very clearly fall in the camp that not only will this get utilized, but you'll also find ways to monetize, and that this we're early in a multi-year boom.
Ashi, I want to ask you one question, but before that, I just want to say that if anybody wants to ask their question on the webinar and speak up, please tell us and raise your hand, and then maybe we'll just unmute and you can ask Ashi the question yourself. While people do that, I'm going to quickly ask you one more question, Ashi. Krishna has asked, many AI model companies are currently losing money. Will they make money? And if so, when should we see the uptick? There are a fair number of questions after this as well. Just
Yeah, sure. Yeah, so I think yes, they are losing money, and I think we would expect them to continue losing money in the near term. Now, the primary reason you are losing money, right? And perhaps I'll just kind of go back to a particular slide to explain where the losses are happening. It's not actually losses. Sorry, just 1 minute. I'm on the wrong thing again. Give me 1 minute. I'm just trying to find a particular slide. Yeah, so we used this particular chart where we showed that each new generation of an AI model requires a larger amount of costs, a larger amount of energy, higher amount of hardware, more data points to actually train. If AI model providers stop spending on developing new age models, you could actually arguably make money on existing models. There's not enough data available. A lot of these are unlisted companies, but broad maths being kind of thrown around is that on a kind of a $10 billion kind of an AI data center capex, you have an ability to do a 1.5 times asset turnover on existing model that is monetized to the end user. You're operating at somewhere close to 40 to 50% gross margins. You remove, say, a billion, 1.5 billion in terms of depreciation costs, say 500 million or a billion in terms of employee costs you're amortizing across all your data centers. And you would actually be quite healthy EBITDA positive on existing models. But because it's a race to kind of be the long-term winner, you will actually kind of keep spending in terms of developing newer models. And therefore, according to us, AI model players will it's a conscious decision to actually not focus on profitability in the near term, but focus on being the long term winners. We actually launched the IME Digital Disruption PMS exactly 3 years ago. We launched it in Feb 2023 when there was huge uncertainty about digital platforms in India because of the large levels of losses. It was a very similar theme. There are strategic values to not making money in the near term in order to build dominance over the longer term. We believe AI model providers are actually likely to follow a similar path. We don't think it's in their strategic interest to try to make money today. But over the longer term, being the owner of intelligence at probably 1/100th or probably even cheaper of the cost of current intelligence should lead to very, very large value creation. How it will be monetized, what will be the monetization areas, we'll get to know over the longer term.
Ashi, Kanchan wants to know what about the security or regulatory guards an investor can have to secure the investments via this Singapore-based company, I think Crystal. Mostly the funds invested resides beyond India's regulators' control.
Yeah, so I think firstly, it is extremely important when you are investing globally, right? Don't go in via unknown jurisdictions, don't go into unknown platforms or unknown funds, right? It's even more important than when investing in India, making sure that you're investing via the right areas. So, say for example, why have we chosen Singapore? It's considered to be one of the most tightly regulated markets globally. Very, very clear kind of regulatory guidelines around how omnibus platforms such as Crystal actually operate, which include all kinds of checks and balances as well as kind of what happens in the case of bankruptcy of Crystal, etc. Lots of checks and balances and very proven regulatory mechanisms. In terms of the actual funds, if you look at the funds that we've identified, iShares is basically owned by BlackRock. It's the largest global provider of ETFs in the country. We're really focusing on investing in the highest, some of the most recognized AMCs in the world. You're investing out of one of the most respected global investment jurisdictions. We are extremely careful to try to avoid US domicile funds because we believe no investor should be taking inheritance tax risk. But Luxembourg and Ireland is where the vast majority of global funds actually domiciled out of. So I think the moment you're careful about how you're investing, a lot of these risks get quite well taken care of. They're not regulated by Indian authorities, but they are arguably regulated by regulators that have been around for much longer and are arguably a bit more sophisticated as well.
Ashi, Rashmi is asking that if one invests through the company and not individually, how does the inheritance tax play out? And is it possible to invest in funds through the company?
Investing via a company, it's a bit nuanced. If you have an operating company overseas, that it's very easy for that company to invest, and you can always transfer money to that operating company and invest via that operating company. As of today, it's actually extremely complex for an Indian company to invest in international, say via Singapore platform, for example, directly. You can actually invest via gift, and gift via gift, you can actually invest up to 50% of your net worth as a non-individual. You are going to have to sacrifice some of the pure play funds. You may not have the same universe of fund options that exist, but you may be able to identify, and we do look at gift. There are not those many pure play tech funds available there, but for companies, there are some, gift is the primary route you could look at. The other route for a company is really kind of focusing on a feeder fund. There are a couple of feeder funds in India that are still open that again offer you global tech exposure. But again, it's a kind of the number of options are a little more limited, and you have to go with what is available as compared to, say, in Singapore, you really get an option to cherry pick quite a lot.
Ashi, I'm just going to unmute Kanchan. Kanchan, would you like to ask your question? You had a couple of questions. I think I addressed just two of them. 1 second. I seem to have lost. Here, 1 second. Kanchan, I have unmuted you.
Thank you. Thank you, Ashi, for the nice presentation. I'm sorry, I'm not able to put myself on video, not in a place to switch on the video. Okay, so I have few questions here. See, basically, Ashi, these all whatever you are saying is extremely very interesting, very encouraging. But as a layman investor, okay, so normally I'm invested in IME PMS also. Now, if I want to go to global market, probably Crystal is an option. But then, even if I go through Crystal, I do not know today, based on the global uncertainties, which geography I should focus on. Even I go to a geography, which sector I should focus on, and how much promising it is. Because today in this information world, there are a lot of information available to us which are not so genuine. Okay, so do you provide any guidance from IME, a kind of model portfolio structure or any thumb rule kind of things where we can get some yardstick that, okay, this much of percentage in India, this much in US, this much in Africa and Europe, and these are the areas we should focus on. Today we are we are hearing about defense, green energy, AI, and then AI everywhere. It's a bit a very much overwhelming situation for a layman investor, really. So sometime to take a right action is extremely difficult. We just and here, but we can't take any action sometimes. That is what, as a personally, I feel actually with lack of any expertise in investment.
No, Kanchan, thank you so much for that question. And I think a lot of other investors would also be facing exactly the same kind of dilemma or question, right? Uh, Now, I strongly am against model portfolios, right? And I'll just explain why, and I'll tell you how we approach this at IME Capital. I think model portfolios are very suboptimal average solutions that kind of make some kind of an average, get some exposure here, but they don't really look at the particular investor, their particular risk appetite, what their requirements are to really be able to build a portfolio that meets them, right? It's very, very similar to you can walk into Raymond's, you can walk into Shoppers Stop, you can walk into any department store and buy a ready-made suit, but it's never going to fit you the way a very nicely tailor-made suit would be. Now, that is really where the kind of investment mandate really comes in, and you already have done part of this with your private banker. Uh, the idea is for us to sit and understand, right? It's not every investor is going to have quite different requirements. A lot of our investors who invest globally sometimes actually have goals, financial goals that are actually linked to dollar expenses. They have a child who may go to some overseas education, and like we all know, like USA, say overseas education can be extremely expensive. A high quality US top tier of college, you look at anywhere close to 70 lakhs to a crore a year, and over 6 years, that's kind of like 6 crores. So the right allocation to international assets, should it be 10-20% of your portfolio, should it be 30-40% of your portfolio? We have a lot of investors who are actually global investors who are not likely to come back to India. In fact, some of them are global kind of foreign nationals. Their global allocation would differ quite significantly from an Indian asset allocation. Now, again, if you're just looking at, say, for example, someone trying to build allocation to the AI trade, if you saw the kind of volatility I showed you in some of the electricity, clean energy, some of the commodity funds, some high risk investors may be quite comfortable with that for the larger potential upsides. For a lot of other investors, that would not fit. So I think any answer given on average, and there are a lot of answers which are possible on average, right? Do 60 to 70% of your allocation should be in India if you're going to have large Indian expenses. 20 to 30% global exposure is what we strongly believe is probably a good kind of place to be in. Within that 20-30% global exposure, US tech is likely to be a biggest weight, but you definitely want a certain amount of semiconductor exposure. Right, so say about 15 to 20% in US tech, 5-7% in say some of the semiconductor plays, and possibly to 3% or 5% in some of the higher risk categories. You can give such model portfolio answers, but honestly, these are, I think, meant for more retail investors. I'd strongly urge you to spend time with your private banker, just understanding each of these options, right? And that's also why we created the RMS for all of this information to also be available for you. But ultimately, the actual composition, I think, is best done one on one to find the most ideal position. Now, a very important element, and I'm just reinforcing this, the moment you're looking at international investing, need to be in via the right structure, the right jurisdiction. There are various elements to look at, and you don't be going in with some unknown entity, and which is why we go in via the most regulated countries, some of the most recognized names, etc. Kanchan, I'm not sure. I hope that answers the question.
Ashi, I'll just wait for Kanchan to reply. Till then, Krishnan also wants to ask his question. I'm just going to unmute you, Krishnan. 1 second. Um, 1 second. Krishnan?
Can you hear me?
Yes, we can.
Thanks, Shagun. Firstly, Ashi, I think it was a wonderful presentation. I should compliment you for this particular presentation.
Thank you so much, Mr. Krishnan.
So
Much appreciated.
in this regard, I'm actually an investor in your PMS scheme. So the question that I wanted to ask is, why can't you replicate the PMS scheme for the AI model? Because today, for instance, when I'm investing in your PMS, I'm not investing in the individual companies. You know which are the companies that you are appropriate, and then what percentage when to come in, when to get out of a particular stock, though of course you hold it for a long period of time. When I look at your RMS portfolio, it's extremely confusing because there are about 20, 30 funds to that extent, and choosing them is a big challenge for us. And also each of them may have a minimum limit. So to that extent, having an exposure to each of those funds, whichever the 5 layers that you talked about, may be difficult. So under the circumstances, is it not possible for you to structure a PMS kind of a thing of this, not the individual companies, maybe of this funds itself, which will benefit for us if you're going to do it through the GIFT City, because to that extent, you know the risk that we have. And whoever wants to invest in that composition of these funds that you choose, I think will be an ideal structure. It's high time you make the job easier for us by doing this.
No, so Mr. Krishnan, thank you so much for that. I can't tell you how much I would love if the regulators allowed me to launch a PMS fund that could directly invest in some of these companies. As a fund manager, I am itching to. We are sitting in India struggling to find growth. You have companies globally which are kind of growing at 50, 60, 70%, right? So one, very much, I would love to, just as per regulations, we can't. But just understand a couple of things, right? And I think that's where sometimes the RMS may confuse a few people. Point number one, there are identified professionals such as myself, right, which are sitting and running these global tech funds that we are sitting and recommending you invest in. That's point number one. Point number two, the RMS has been designed to create transparency so that investors get direct access to our insights. But we are a traditional wealth management firm. Every investor has a private banker associated with them. It is the private banker's job and responsibility to sit, understand the investment requirements, and therefore show them that these are this fund. It may be one fund, it may be two funds, it may be three funds. It is for that private banker to sit and give the investor, these are the 1, 2 funds you have to invest in. We are not expecting you to go in and go sit and search and try to figure out. Honestly, the investment landscape is too complex. What we are trying to achieve via the RMS is, too often in the wealth management industry, I can tell you, most companies in India, you'd have a private banker going telling you this fund is good, and they'll go tell some other investor the same fund is bad. Right? They'll highlight the positives, they will not talk about the negatives. The RMS prevents that from happening. But we do not expect, with the exception of a small minority of investors, the RMS is not designed for you to go and try to identify for yourself. That identification of funds will be done by our private bankers. It's effectively the same. There's some fund manager like me sitting overseas who arguably is in a much better position than I am to kind of understand these spaces. That fund manager is taking the call. Which fund out of those 20 funds that your private banker will sit and help identify, Private bankers already have their own, they are kind of model portfolios at some level we've created, right? As in, we know that US tech, you want one or two of those core funds, of the core US tech funds. You probably want a minimum of one semiconductor fund. Investors with a slightly lower risk appetite may go with the semiconductor fund via the iShare Asia fund, which is not giving only semiconductors, it's also giving certain others. But investors with a slightly higher risk appetite, you probably want to go in directly to a Taiwan or Korea. We are not expecting investors to sit and have to try to make these decisions themselves. That is for our kind of private bankers to sit and do it with you. But what I strongly believe in is that the simplest thing for us to do is to sit and give a ready-made answer. 50% in this fund, 20% in this fund, 20% in this fund, 10% in this fund. I can give it to you right now. But it won't meet your requirements as closely as something and deep consultation with the private banker. And that's honestly the core of what we believe, that portfolios need to be customized to their individual's requirements because no two investors are the same.
Ashi, Paridhi has asked a question. What are the most
Sorry, no follow-ups, right, Krishna and Kanchan? Because I think they're still on mute.
Yes. Oh, okay. I haven't addressed Paridhi's question at all, so I just quickly
Oh, okay,
want
sure.
to.
You can just go on. And possibly, Kanchan, if there's something I've not covered, please raise your hand again.
Yes. Oh, Paridhi has asked, what are the most relevant Indian listed companies to track or invest in for the AI mega trend? Ashi, I see you smiling. So obviously, this is a question you get asked a lot. I've seen that before as well.
So this is something we've been really struggling with. I think the simple, unfortunate reality, and we hope this will change quite dramatically as we're going ahead. The government has announced various PLI schemes to try to incentivize kind of semiconductor and various other electronic equipment manufacturing in India. But as we stand today, India is largely absent from key elements of the AI value trade. Amongst larger, more established companies, there is no clear direct beneficiaries. In fact, one of the reasons you've seen a lot of FI outflows from India in recent years is that FIs are kind of repositioning also to participate in the AI value trade. And if you want to participate in the AI trade, you have to go towards kind of the Koreas and the Taiwans and the Asias and the USs. Um, at least as of right now, proper participation in the AI value trade is more an international kind of a play. You don't really have a lot of the larger, more established Indian firms really don't give you exposures. In the small cap space, you may get certain companies. We've recently introduced in our microtrends portfolio one such company, but honestly, this is really not a platform to be discussing specific stocks or direct stocks, and it's also small cap, so risk there can be really high.
Ashi Joya Mohapatra has asked a question. If AI keeps automating both routine and high skill cognitive tasks, what clear mechanism will ensure net job creation instead of long term displacement, and how soon?
Okay, so this is very interesting, right? And I think to answer this, you have enough historical evidence. Uh, let's just take the most recent information era, which has come before the current intelligence era. What you saw with the kind of internet, right, is the marginal cost of distribution reduced dramatically. Access to information shot through the roof. If demand had remained steady state, and if the world continued to operate the way it operated in kind of uh, early 1990s, there would have been a quite strong unemployment, quite a strong depression, etc. But the simple reality is that every time you have seen a big increase in technology or productivity, there's also been strong incremental services that have come about. A very, very simple example is what we are doing right now. We are sitting and we are on Zoom. We have investors from all over the world, all different parts of India, sitting and logging in. Such seminars were only possible in the physical realm earlier. Because you move from physical seminars to much narrow audiences to a much larger kind of pool, the amount of online meetings, the amount of seminars has exploded. Look at, if you're seeing written content, the sheer amount of blogs that have been created, looking at images, looking at videos, look at what's happening on YouTube. Every new wave of technology comes with a huge increase in new services, new products, new demand, etc. So, what we believe, and it's not that there will not be transition impacts, it's not that there may not be periods of unemployment, etc. But we strongly believe that demand will move up substantially. You'll see a boom in creativity, you'll see a boom in innovation. Access to information, access to intelligence will allow a lot of products and services that we can't envisage as of today really coming out. And the big productivity gains that AI is basically helping create, that will, according to us, get used in some of this incremental demand. And I think just recently, Infosys in the AI summit, just yesterday, right? They made a comment about how a lot of this very traditional old legacy code that runs a lot of systems that no one was willing to touch earlier, you could now sit and actually look at modernizing those. So I think that is our view, yes, but it is important to understand that it is a new technology. There is going to be transition risk, and which is one of the big reasons we believe it is that important to have AI as part of your portfolio. If you are going to have traditional businesses that may get impacted in the near term because of big productivity increases, because of new competition emerging, etc., you want to participate in the direct beneficiaries of the particular trade.
Thank you, Ashi. Dharam, I know you're still here, so thank you for waiting so patiently for your question. Which companies are investing in Vishakhapatnam, which is being made the AI capital of India?
I think that's probably a bit too early to say. As in, it's very very early, and at least in terms of there are companies coming out. There is a lot of interesting stuff which is happening in terms of the Indian government trying to, be it in AI models, be it in the manufacturing of semiconductors, various different parts of the value chain. Right? It was very interesting. India actually has the second largest number of semiconductor designers in the world after the US. So there are initiatives being taken to try to make us participate in the value chain, but at least at this point in time, clear, established, investable opportunities are fairly limited.
Ashi, I think we've answered most questions. I think, Kanchan, if you still have a question that, if some part of your question has not been answered, please let me just quickly unmute you and you can ask that question now.
Okay, thank you, Seven. So, Ashi, one thing, in your IME newsletter, are you planning to cover such sectoral move globally that will give the investors a kind of idea that where we should focus our investment? Because we're saying to reach to private banker and all, but for us as a layman, again, to find out a private banker, also maybe we need a help of your RMS page. I don't know. So, do you think that it's possible for you to cover those kind of things in your IME newsletter, the different sectoral view, green energy, AI, or whatever defense, whatever coming up, so that we can start exploring those opportunities?
Kanchan, thanks a lot for that. In fact, we debated this exactly in this month's newsletter itself. Right. So if you see in
Okay.
the newsletter, we do actually have our views across Indian sectors. But as global investing becomes more and more important, our own view is that, 3, 4 years ago, people were saying 10, 20% of portfolio exposure to international may be a good idea. We believe as AI becomes more and more important, perhaps India catches up very rapidly in the AI value chain, but if it's not, we believe you need a higher allocation to kind of international investing. And if it is an important kind of part of the overall portfolios that our clients are exposed to, I think very clearly we will incorporate our views on this, on the kind of various components of the AI trade, various components, etc. We already, if you notice, do cover international. We'd probably increase exposure there. I think one of the other elements, Kanchan, is we're trying to progress the RMS as much as possible. One of my core visions when I started IME Capital is trying to collapse this gap of insights that exists between kind of fund managers, central research teams, and the end investor who's actually deploying capital. What you are going to see quite significantly over the coming months, a lot of very short, concise video content, 2-3 minute explanations on key themes. You will see our stances across different categories, different geographies. You will see our top recommendations, a lot of new incremental things coming out. I think a lot of this is driven by this vision that there should actually be as low a gap between an understanding central research and the investor ultimately who's investing the money. So thanks a lot for that. We will definitely kind of look at starting to incorporate some of this in our newsletters going forward. But we are also going to be incorporating a lot more of this into the RMS in different ways. Ultimately, we want our investors to be as informed as possible. All investors have a dedicated private banker who is sitting and helping them explore and understand and come out with a truly customized portfolio. But ultimately, an investor needs to understand what they're investing in, why they're investing in. And that's where really all our communication objectives are kind of arise from.
Okay, thank you. Thank you, Vashi.
Thanks a lot. Thanks, Kanchan.
So from today's call, what will be the net 1, 2, 3 takeaways? That is what I am trying to just recall. Maybe one thing is the Crystal platform. Second thing is the multiple opportunities on Crystal platform. Okay, but again, decision taking all still lies with the investors and with the help of the private bankers. That is what it comes out.
Yeah, so I think, Kanchan, if you're trying to consolidate into 2-3 key takeaways, I think takeaway one can no longer ignore the value creation happening in the global AI trade. Secondly, there are clear routes available for Indian investors to participate. And thirdly, in order to find the most appropriate solution, spend time with your private banker, understand what each of these options are. They'll take you through each of these and try to evaluate. Some are higher risk, some are lower risk. Try to understand which make more sense to you. But our core view is that AI is going to be transformational. A significant amount of value is likely to flow towards AI and AI big tech. And if you just see conceptually, what is it doing? The brains that we have here are getting replaced by semiconductor
Right.
chips, right? We are currently quite expensive professionals. Chips that are significantly cheaper than us are going to be able to start replacing a lot of the work that we're doing. When there's such a gap in the cost of delivering a service, you're going to see a huge amount of value shifting towards that. That will keep leading to more and more demand for computing resources. And therefore, as investors, we think it's valuable for us to participate in that theme. I think that those are the probably key takeaways.
Okay. Yeah, got it. Thank you.
Thanks a lot. Thanks, Kanchan.
Actually, Kanchan, thank you because you managed to help us sum up the webinar. So that was actually quite helpful for us as well. Ashit, can we take one last question or?
Sure, we can take as many questions as.
All right. Okay, because I just got a question from Shrishel Kambi, who's asking that in the AI stack, the topmost layer is apps and the bottom layer is energy. Is there any take on this?
So I think the core is more than something being at the top or something being at the bottom. Is each of these are going to have different dynamics in terms of risk reward. You have certain kind of areas, right? So if you're looking at semiconductor design firms, if you're going to look at model makers, these are owners of intellectual property and they're likely to be clear winners and clear losers. And therefore, value creation is likely to flow disproportionately towards a few set of companies. This is arguably a slightly higher level of risk investing. With higher risk comes higher potential reward. There are layers like kind of semiconductor manufacturing, where you aren't really taking as much of a technology risk as you're really saying, is Taiwan Semiconductor going to keep having new and more demand for their semiconductor chips? They are not dependent on does Gemini win, does Grok win, does ChatGPT win. Whoever wins, TSMC will have demand. So I think, and which is why, we've had so often people keep asking us why not model portfolios, and we keep saying you really need to understand an investor. You need to understand their requirements and build something that fits them. So I think the layers need to be looked at from that perspective. Different risk rewards, different payoffs, and accordingly, different levels of attractiveness for different types of investors.
I think with that, we have answered most questions because I think you answered some of the questions within other, answers as well. I want to thank everybody. Ashi, thank you so much. You really had a lot to say, and everybody's been listening very patiently. So thank you so much. Ashi, is there anything else you want to say, just to wrap things up?
No, I just wanted to thank everyone for very patient listening. I think it was a slightly difficult topic because some of it is technical, but you had to cover some of that technicalities to really understand the theme. So I hope it was kind of useful, and I hope it does achieve an objective of people starting to kind of look at and examine investing in the AI trade, because this is something that we believe will create a lot of value going forward.
And Anand has said, thank you so much for the nice and elaborate information. Should help in taking baby steps into AI investing. So, yes, Anand, I'm so glad that we could help. And for everybody who joined us today, thank you so much. We do conduct a lot of these webinars. So, please be in touch with somebody from the firm and stay close. We'll keep announcing our next few webinars. If you do have any questions that weren't answered, we're just going to have another look, and then maybe someone from the company will be in touch with you. Thank you so much. Have a great evening, everyone. Thank you.
Thank you.